The market might be correcting right now. A correction is a 10% drop in price. The market may even be going towards a bear market. Actually, I have no idea which way the market is going. You read these people every day in the newspaper, financial press. You see people on the TV, and they seem to be predicting what's going to happen with the market at the same time saying that no one can predict the market. And if somebody could predict the market, what they would probably do is not tell anyone. They wouldn't go on TV. What they would do is take their money. If they really had charts, or if they really had some economic factors to know exactly what's going to happen with the stock market, they'd invest all their money. So here we are, it's the first week of February, and the stock market is already down anywhere from 3 to 6% depending on the index. And if you've not heard already, if the market does continue down, which I'm not suggesting it will, as I cannot predict the market, but if it does continue to go down, you can expect to hear the drumbeat of people talking about how we're having another correction, crash, bear market, whatever it may be. Now, if the market quickly goes back up again, then you won't hear anything about the market being in a bad state. But there's a couple things that you can do to prepare yourself for the fact that the market will go down again sometime. I don't know if it's this year, I don't know if it's next year, or 5 years from now, but what the market does is it goes up, and then it corrects down, and then each time it seems to go up a little higher, even though there's no guarantees of that. But what I'm suggesting today is there's two things that you can do to really prepare yourself for the next time when the stock market goes down. And the first is ignore all the news. And it's very hard to do. But don't get consumed. Don't enjoy the doom, gloom, and boom type news that comes out. And don't worry about it. It's easier said than done. But people that look at their statements every month and analyze every investment typically do poor. Women are actually better investors than men from all the studies, because women don't go crazy with looking at it, because the more you look at it, the more you want to make changes. And I think that's probably the greatest value of a financial advisor or planner, is somebody that tells you, hey, stop. Don't make any changes right now, because we want to make changes when the market goes down, and we want to buy more stock when the market goes up. So that's the first thing that we can do, is ignore the news, because it will come again if the market continues downward. The second and probably most important thing that you can do is called asset allocation. And asset allocation before the fact. Right now it's a great time to look at your asset allocation. What is asset allocation? Well, it's the percentage of stocks, bonds, cash, REITs, MLPs, alternative investments, whatever your allocation is. It's important to know what it is, and it's important to rebalance towards it. And that will reduce the risk if the market does go down. It won't take it away, because sometimes things do move at the same time. But let me give you an example. Last month, the stock market in January was down 3 to 4%, and REITs were up by about 3 to 4%. Bonds were up about 1%. So those people that held a more diversified portfolio did not have the major fall. Their stock investments were still down, but other things made up for it. So that's really the benefit of asset allocation. So again, what I would recommend you do is look at your asset allocation and rebalance. Do it now. Don't wait for the market to be down 20 or 30%. Yes, you will miss some of the upside if you have more bonds. And I look at bonds, to use a Super Bowl metaphor, I look at them as being more defensive, and I look at stocks as being more offensive. And to get the defense with bonds right now, you probably have to go with very short-term bonds. Don't go long-term, because if interest rates go up, bond prices go down. So, so in closing, take your age. There's two different ways that you can use asset allocation. You can take your age and subtract it from 100. So if you're 40 years of age, take 100, subtract 40, and then you get 60 would be the amount of equities or stocks you want to have in your portfolio. That's a conservative way to do it. There are people, however, that say you should take 120 and subtract your age. So that would be, if you're 40 years of age, you would be having an 80% equity. Finally, the reason why corrections are so painful is that when stocks go up, like they did last year, let's say, for example, you have $100,000, it goes up by 30%. How much money do you have? You have $130,000, right? So then the market the following year goes down 30%. So it went up 30% in one year, down 30% in the next year. How much do you have? The gut visceral reaction would be you have the same amount of money. But the simple laws of arithmetic suggest, and you can use a calculator, that if you have a 30% increase and then a 30% decrease, you would only have $91,000. So $100,000 going to $130,000, then having a 30% correction is only worth $91,000. So when markets correct, it can be very painful, and my suggestion is to plan today to have the asset allocation to take you into whenever the next correction comes. So thanks for watching.